Well, good afternoon, everybody. This is the second video we've shot this week from Vermeer Investment Management. Charlie Fricker and I are in the office again today, trying to pick through the noise and news of yesterday's Federal Reserve rate hike. We put out a short video in advance of that meeting, and we just thought we would jump on again and update you with our past thoughts. Why don't we start, Charlie, just with a summary of what exactly happened last night, and we can move from there.
Yeah, obviously there's a lot going on in central bank world at the moment, but with the Fed from Wednesday evening, they sure a lot of our viewers have seen the news. They raised rates by 75 basis points in the largest rate hike by the Federal Reserve since 1994, taking the range rather than one actual rate. The Fed has a range of taking it up to 1.5 to 1.75%. And with it being a quarter meeting, they also put out a lot of their updates for their economic projections for the outlooks through for the next couple of years. And interestingly, they've moved up their expectations for where rates are going to be from a medium perspective to 3.4% by the end of this year. I think when we were looking at expectations back in December, that might have even been sub 1. I think when looking back towards the end of the year, they see inflation, what they look at core PCE inflation up at 5.2% by the end of the year. Fed seem to think they can get this down to 2.2% by 2024. They do see the unemployment rising a bit up to 4.1 from 2024. We're at 3.6% in the US at the moment. And as expected, they also took their growth expectations lower for this year and some of the outer years as well. I mean, there was two things, I suppose. During the meeting, equities rallied off and bond yields were very, very volatile after Powell seemed to take a 100 basis point hike off the table for the next meeting, when indicating they think 50 to 75 basis points would be appropriate. I find it amazing sitting here thinking that we're watching equities rally after the Fed takes off a full 1 percentage point increase, potential increase to interest rates off the table. But there we go. But looking out onto the new dot plot, I thought it was interesting that the range of the dots now in 2023 and 2024 is incredibly wide. I think out towards 24, there might even be 2 percentage point difference between the highest expected rate and the lowest, from where different FOMC members see interest rates going. And I think that really highlights the difficulty, both for us in the market as to where we think rates are going to go, and their own Fed members as to what they think rates should be based on where growth is and inflation is likely to be. And I think that really highlights the issues and the fundamental, difficulties of how to try and position based on all this information that we're getting. In his press conference, Fed Chair Jay Powell seemed to indicate that the economy's strong, the consumer's in a good place, thinks they can engineer a soft landing, maybe not even cause a recession by hiking. And yet some of the data points we've seen over the last kind of couple of weeks have really hinted that the economy might not be in as strong a position as he seems to think. And the retail sales data only a few hours before the Fed meeting wasn't hugely encouraging, was it? I mean, what were your thoughts on the outcome from yesterday?
Well, I think actually that's a really good place to start, actually, because simultaneous almost on the day to, as expected, that 75 basis point rate hike occurring, which had been effectively, I guess, sort of almost semi-leaked post that very strong inflation print on Friday, where suddenly expectations of a much higher rate hike got into the market and obviously really upset equity and bond prices once again. And as you said, we had that relief rally in stocks because suddenly we weren't going to get 100, which is absolutely astonishing. And of course, equities have not followed through and are much weaker as we speak early this afternoon in the first trading session that followed the news. But, those retail sales numbers were weak, and we look at some economic studies, don't we, in terms of GDP expectations, which we now see at 0, for the second quarter, and we've already had one negative quarter. So there seems to me to be something of a disconnect between this view that the economy is very strong and the consumer's holding in. We did talk about a shift in spending, and I do get that. But, what is really interesting is as we progress through the year, as these challenges persist in terms of weakening economic activity and further hikes in rates, and the likelihood that actually we do significantly slow and tip into recession, how willing is the Federal Reserve to continue with this aggressive policy to get to neutral, or whatever they perceive as neutral, at the same time as the economy is in recession. So I think it's the forecasts that say that we can do these hikes to get to neutral by the year end, that GDP growth will still be nearly 2% in 2022, 23 and 24. And unemployment will only tick up from around 3.6 to 3.7%. I mean, if those things come off, that will be a great outcome, and well done to everybody to get rates back to normal, from starting from well behind the curve to get back to normal and still have GDP grow at nearly 2 and have virtually full employment in the US. That seems to me to be a really, really tough thing to accomplish. And it seems much more likely to me, and you can see the way stocks are reacting today, that people are now, are more fearful of a recession because of these policy shifts that are being forced upon us by the desire to get to neutral. And, one of the things that you and I have talked about a lot, and I think we referenced it in our last video, is the element of the exogenous factors here. And it's probably worth touching on, isn't it? The difference that we may see between headline inflation caused by higher food and energy prices and core underlying inflation starting to come down, and how the Fed reacts to that going forward is going to be really interesting if it comes concurrent with a significant slowdown in activity. We'll see then how aggressive the Fed will continue to be if those two numbers start to really differentiate. What do you think about that, Charlie?
Yeah, I think I agree with all you said. I think we were reading something before we started this video that in some cases the cure for high prices is high prices, and we've in loads of sort of asset classes, whether it be within retail, when you look at how much you're paying for petrol at the petrol station, where is that point where the consumer just says, I've had enough, this is too much for me now. And maybe the faster that comes through, the faster demand rolls off. Yes, it might lead us to a real slowdown in growth faster, but then you almost get to the end point in a quicker speed. So you don't elongate some of the problems or the issues that we're having to deal with. And I think the Fed internally is kind of rumbling with that. What do I try and do to lead to the smallest, less upsetting outcome? Whereas you look back into history and you see what the likes of Paul Volcker did, raising rates enormously aggressively, only to cut them very, very short time later because he quelled inflation. He'd done his job. He had impacted growth, but it was kind of a shorter, sharper impact to quell those issues. And I think it's not just a US problem, inflation, and trying to deal with it, and the big shift in central bank attitudes. I mean, we saw earlier today that the Swiss National Bank raised their interest rate by 50 basis points, really surprising the market. And I think the first rate hike they've done in, I don't know, maybe even 15 years, I think. They've only hiked to, I think, still negative, about minus 0.25. So there's still negative interest rates. But for a Swiss National Bank to raise rates is telling you something about all these banks trying to start to do things now. And again, playing from behind the curve. And the Bank of England also today raised their interest rates. So the expectations of the market were for 50 basis points. They've raised them by 25, raised, I think, every meeting now since December. And indicated, at least in their statement, that the Bank of England will take more action over the course of the year. Really,
did that surprise you though, Charlie, that they didn't? There was a lot of discussion, wasn't there, about we're seeing this front loading. Let's try and get there quicker. Did it surprise you that the Bank of England only did 25 basis points? To be fair, they have been raising rates earlier than other central banks, and maybe the evidence that the economy has slowed here is greater, and maybe those exogenous factors like oil and food are having a greater impact. So you think that was the correct decision based on where we're already at, or do you think actually they should have gone more all in and then been able to make more dovish comments?
I think there's arguments for both ways. I think think about raising more aggressively now to have more flexibility later down the track, or within their statement was a bit confusing in that they still seemingly worried and hawkish about where things are going further down the line, but yet they only raised by 25 basis points. I think they wanted to try, and you could argue they've kind of chosen the best of both worlds in terms of not raising because the economy's already weakened. We've seen the data in the UK has slowed significantly in the last kind of month or two. So the UK economy is in a bit of a different position to where the US is coming from at the moment. So you could argue that, well, pausing now because of the weak economy might be right. You could argue that 50 basis points should have been right because, you know, they're calling themselves that they think inflation is going to hit about 11% at the end of the autumn. When the energy price cap goes, at the moment, forecasts are it'll go up again quite aggressively based on where prices are currently. So I think it's stuck between a rock and a hard place, as are most central banks across the world, and it's all bigger really because none of them took any action this time last year when the economies were all in a really strong place, and you could be hiking into a strong economy rather than the situation we're all finding ourselves in now, that they're trying to have to hike into potentially into a slowing economy, which is not what you want to be doing.
And that, of course, goes back to the debate we were having earlier this week about how this time last year the entire discussion was around inflation being transitory, and now the debate around inflation being that it is going to be more persistent, and hence the very aggressive action that we're seeing. And, you know, I mean, headline numbers like 11% for inflation as you're heading into winter, and that's being caused by energy bills, is a real challenge for central banks and the government alike going into that. And, you know, I think that's obviously why the central bank is taking the action, taking that, and saying they're prepared to do more if necessary. But, you know, as you say, Charlie, that, you know, these are the challenges, and these are why asset markets, whether it be bonds and or equities, are really being challenged at the moment. And we're seeing very little respite, you know, temporary short-term rallies in stocks that then get filled in very aggressively by bad headline news on inflation, and, you know, and then fears of what the response to that inflation is going to lead to in terms of recession and the impact that's going to have on earnings growth and on company margins if there continue to be supply chain pressures. And, you know, some of the things that we're going to have to look at carefully are those margins for our companies that we invest in. You know, as a reminder, you know, Vermeer, we run a long only 50 to 60 stock global portfolio all around the world. You know, there's a balance between growth and value. We do try and focus on quality, whether it be growth or value. But, you know, despite that, you know, we've seen some significant valuation compression in some really good businesses this year. And, you know, there are obviously concerns about the outlook for corporate earnings and margins going forward. So, you know, all these things are providing a great challenge to equity and bond investors. I mean, very difficult for everyone right now. So with that, we will leave it. Thanks for your time there, Charlie. Thanks to everyone who has tuned in. We will continue to do these videos in the coming weeks and months. I hope they're useful to people listening in, and hope everyone is doing okay. Thanks very much for your time.